More people on Facebook than on YouTube this time around. So that's a little bit different. But it looks like our audio is good to go. Get your beverages, water, tea, coffee, whatever you like. Whatever helps you stay alive. What is it? Alive, awake, alert, enthusiastic, something like that. If you prefer a more adult beverage, some wine or something like that. I think last week we had somebody enjoying some bubbly. We had somebody enjoying a carbonated water, which was good. I do advocate that you enjoy yourself and that we have a good time. But if you do have a drink, don't have too much. We don't want you to miss out on the information. Everyone here for the first time? All first timers, or we have people who are attending for a second time? I know that happens from time to time. I always wonder if people are willing to say if they're a second time attendee. Okay. Yeah, got a lot of people here for the first time. Roberta, yeah. Okay, Diane is a first timer. William's a first timer. Who's playing the violin, or is that a fiddle? Char Blake, first time. Okay, great. Oh, stuck at work. Oh no. Well, that's why we're here, so you can file your Social Security, get retired, all that good stuff. So we'll try to get you unstuck at work there, Mark. First time. The recording, so the way this works, if you've never done a YouTube live, for example, Mark, I see you're on YouTube, so that's great. If you get to where you can't stay on for some reason, you can just rewind it, okay? But when the presentation's over, it'll stay live for, I think, like 12 hours or something. I mean, for a little while anyway, it'll stay live, and you can just rewind it, watch it back, that. But it's not forever, yeah. Your boyfriend and his violin. Okay, it's a violin, not a fiddle. All right. My dad plays the stand-up bass, and until he moved, he and my mom moved recently. He was in a gospel bluegrass band, and so that's always the joke. What do you call a, what is it? Something like, what do you call a violin with a stand-up bass or something? I don't know. A fiddle. That's the punchline. The punchline is a fiddle. But first timer here too. Okay. All right. Cool. Great. A lot of people here for the first time. Great. Glad to have you. We'll get started right at the top of the hour. Oh, I'm so sorry to hear that, Diane. Yeah, cancer, unfortunately. Yeah. Catherine's asking written materials for download. No, we have a workbook that we'll mail to you, but it's a big, long process to get our presentations. Not be able, for some reason, I'm going to try one more thing. I appear to not be able to launch our communication thing here. Can you share this? Yeah, of course you can. Yeah, absolutely. Hey, Frankie's going to a bluegrass festival. Great. Which one? Isn't there one? I can't remember when exactly it is, but isn't there one? Okay. Let's see here. I'm working on my sign-in ability. to my messaging with my tech team. There's one in Indiana, I think around this time, roughly. Is the workbook downloadable? Not yet. We're working on that, but right now it's a physical copy. We mail it to you the old-fashioned way. We rely on the United States, the good people at the United States Postal Service. I got to verify myself again here. Okay. Okay, we're going to get started here in just a couple of minutes, 8 minutes. Hang tight if you haven't already. Got yourself a cup of water, glass of water, cup of coffee. If you can't handle it, do decaf, of course. Tea. You go down the wine or an adult beverage route, please feel free, but just know that while it's just Social Security, it's not too crazy complicated. We would hate for you to miss out on understanding what we're doing here together. Okay. Again, for my tech team, I'm not sure if I'm going to be able to use our normal communication. It's forcing me to do a download here, so sorry for that. Hopefully we don't have any tech problems. If we do, my tech team hopefully will step right in for us. The Bean Blossom. For some reason that sounds right. In Indiana, is that the one you're talking about, Frankie? I thought it was like, yeah, I can't remember. I haven't been, but I would like to go. I do like bluegrass music. Got a first timer from Florida, very cool. Hi, Rosalinda. Glad to have you. Get started in about 6 minutes. It's raining like crazy here in Michigan. That's where I'm at, in Michigan. My wife just sent me a photo, and normally I wouldn't have seen it because I'm trying to make sure I can communicate with my tech team in case we have any issues during the presentation. I'm looking at my phone. I try to show you, but apparently my street is a river right now. So that's exciting. She said it's draining nicely, so that's good. My kids are probably out splashing in it right now, would be my guess. Okay, all right. Okay, to my tech team, we're working, we're in business.
30 minutes before the broadcast and 15 minutes before the broadcast, but absolutely no more than 15, no less than 15 minutes before the broadcast. Okay, so the first thing we do here is we're going to lay out and we turn the buttons on.
Okay, looks like someone is already angry. Yeah, that's right. I do see your likes and loves and faces that you make at me on Facebook there. Someone already gave me an angry face, so that's very nice. Here. I appreciate that, whoever did that.
So that.
I hope you're not angry at me, but it's always possible. Never too soon to upset someone. We get started in about 5 minutes, so a little quick countdown. If you need to run to the restroom, get a glass of water, something to drink, please feel free.
And I know how to do this.
Looks like we have good numbers of people here.
Links.
Not half the number we're expecting yet, but I see a lot of people joining in actively right now. So I think we'll be good to start on time. Sometimes we like to give just a little bit of wiggle room whenever we have, I think, problem with the text messages going out. But it looks like everything's gone out pretty well. We've got good numbers of people in, about 120 people between Facebook and YouTube. We're expecting about 250, so about half the number of people, but that's not untypical 4 minutes to go. Okay. Okay. Got a lot of people here. Great, great. Yep, good. Hi, Willie. Hi, Barbara. Glad you're here. Kathy, glad to have you. Janie Blair is asking if this is scheduled for 1 hour. Yes, indeed. Yep, about an hour. A little more than actually. If you ever have any problems at all, if there's any issues with the stream, like we disconnect for some reason, those of you who are the conscientious ones of you, you know who you are. Okay, so if you're a conscientious person, please listen to me now, because if we have any issues at all with the stream, all you have to do is go to your email or the text message that you originally got, click back into the stream. Okay, so you'll click back, it'll take you right to the website that you just clicked from to join us here on YouTube or Facebook, and we will relaunch just as quickly as we can. So if we have any problems at all with the stream, we will kill it and relaunch it right away. Okay, but it means you'll have to switch. But we'll make it available ASAP. So any problems at all. And for those of you who are very conscientious, put that in the chat. So if we're having any problems and everything's locked up and nothing seems to be working and we're shut down, just remind people. You can be the reminders. Okay, appreciate that. Sorry to hear that, Janie. Leaving at halfway through, so all you have to do to watch the rest of this, it stays up for about 12 hours roughly. Okay, so it stays up for a little bit amount of time. So make sure you get back to it and you can watch the rest. But yeah, it's something that will stay live for a little bit of time. I think about 12 hours. Then it comes back down. Hi, Cynthia. Okay, we're going to get rolling here in just a minute. Looks like we've got, let's check our numbers here. Got about 150 people. So I think we're doing pretty good. Just checking with my tech team. Make sure all the notifications went out correctly. Okay. I asked if all the notifications went out, and my tech team says, "Oh yeah." So we're good. I think we're good to go. All right, let's get rolling. Uh-oh. That's not good. That was not supposed to happen. There we go. Okay. Welcome, everyone. My name's Kyle McCauley. I'm one of the national presenters here at Einstein Retirement Workshops. Einstein Retirement Workshops is a national educational organization that focuses on providing retirement education to those who are gearing up for getting into retirement or already retired. And so we have several different topics that we do presentations on, in addition to things like our daily podcast and Retirement 360 weekly podcast. So we'd certainly invite you to check those out. We'd love to interact with you on those as well. This is our most popular presentation. It's now been attended by more than 100,000 people have signed up to show up to one of these workshops. And so you're one of those now. So congratulations, and we welcome you. We're happy to do this. This is something we used to do face-to-face. We would have seen you at a community center or a library or university, something like that. But now, since COVID and all the travel restrictions and that fun stuff, I shouldn't say fun, but you know what I mean. We now have been converted over into doing these in this live stream format. So we're very honored that you're here with us and that we are able to still do this for you. And really, now that we've been able to reach out and work with so many more people who are in locations that, frankly, we just never traveled to. So now we've been able to touch so many more people. So we're very honored by that. Our agenda for today, we're going to spend just about an hour on the topic of Social Security. At the end of that hour time period together, we're going to do two things. Number one, we're going to talk about how you can get access to our Social Security filing workbook. This is a workbook that we will be mailing you a physical copy. We're happy to do that. And so we'll talk about how you can request that workbook. Everyone here in attendance for attending, we will send that to you at no cost. So we'll discuss how to get that right at the end. Also at the end, we will go into a question and answer portion of our time together where you can put your questions into the chat. I've had many people putting things in the chat, and you've seen me highlight them. If you were here on time, you've seen me highlight those chat comments, and I will do that with your questions so that I'll highlight a question and answer it. Right at the end of the presentation, we'll go into that Q&A portion. If you're like me and you have a question, don't not write it down. Write it down, jot it down. Make sure that you don't forget that question because if you're like me, you'll probably forget in about 5 minutes. So make sure that I answer it, and I want to answer your questions. We'll do that again right at the end of our time together. I want to share with you a little bit about my background, just so you have a sense as to what my perspective is when I do this workshop. So I am the managing partner of City Center Financial, which is a retirement planning firm. I am a chartered retirement planning counselor, an accredited portfolio management advisor, and also, as is every member of our team, a national Social Security advisor certified professional. So the reason why I share all that with you is just so you understand that when I do this presentation, the thought process that I have, the experience I'm drawing from and sharing the information with you today comes from our work in helping folks who are gearing up for, who are in retirement, who are planning out how does Social Security fit into their retirement income and planning strategies. And so those are the thoughts that I'm having, people just like you. So we think that you'll find this to be a very practical and useful presentation. What it is not is a presentation to tell you the specifics on how to file your benefits in terms of the logistics of going into the Social Security website. We're not affiliated with, nor are we employed by Social Security. We're not going to sign you up for benefits today. That's not our point, okay? Our goal here is to give you some advice that comes directly from our experience and expertise in this area of Social Security, but that experience coming from helping hundreds, well, really now thousands of folks make high quality Social Security decisions just like yourself. We are able to do that and give that advice because of our registered investment advisory firm, City Center Advisors. Why is Social Security such a hot topic? Why are all of you on here today? Why have we had more than 100,000 people sign up for one of these events over the last year? Well, because there's a lot of you who are qualifying for benefits. Okay, about 3.64 million new folks are turning these magical ages where they can qualify for things like Social Security and Medicare, and that's expected still to continue for another 13 years. So that's a lot of people who used to be working, paying taxes into the system, again, specifically the Social Security and Medicare system, who are now retiring and actually drawing funds out of that system. And so it brings up issues and concerns, things like insolvency. Is there going to be something there for me? That seems like a lot of people. So we'll certainly address that for you. Now, in terms of what the benefits will mean for you, we do find, the research has been done to find that about 65% of middle income Americans derive more than 50% of their retirement income from their Social Security benefits. Now, obviously, that's true for those who have not done maybe the best job of accumulating other types of retirement income, whether that be a pension, putting dollars into a 401k plan, something like that. But for those who have done a good job of accumulating those pensions and 401ks or other savings accounts, for those who have done that, Social Security still makes up a big portion of many folks' retirement income. And the reason for that is, number one, I think if we were in a room together, I've done this live enough to know this, that if we were in a room together and I asked for a show of hands, how many of you were told don't plan on Social Security? I'm sure that many, if not all of you, would be raising your hand. And so the reality is the benefits are still here. And in many cases, frankly, they can be quite good. So since Social Security makes up such a large percentage of retirement income, that has elevated its importance. Okay, so let me say one other thing about that. It is not uncommon for us to see a married couple, between the two of them, 40, 50, 60, sometimes as much as $70,000 to $80,000 a year from those Social Security benefits once they both filed. So the benefits are here and they're quite good. One of the reasons also why Social Security has become sort of elevated in terms of its importance to a retirement income plan is because since 1985, we have seen 84,000 pensions eliminated. Now, that doesn't even count the ones that were frozen, benefits were reduced. We've seen pension buyouts being offered like crazy. Unfortunately, we've also seen pension benefits that have been reduced after folks have filed them. And so that again has elevated the importance of these Social Security dollars. Also, 46% of Americans today currently pass away with less than $10,000 to their name. Why is this statistic here? Well, when you frame in your Social Security benefits and you're thinking, okay, what do these benefits really mean to me? The thing that you want to view Social Security as when you're framing it in, okay, how does it fit in to my retirement plans? The way you should think about Social Security is as retirement income insurance, or you could say longevity insurance. If you were to ask yourself, do I insure the important financial things in my life? I think that many of you would say, yes, of course. How about your house? Yeah, I insure my house. My car? Absolutely. How about my health? Yeah, I have health insurance. Do you insure your retirement? The answer, actually, for most of you, if not all of you, is yes. Social Security is a form of retirement income insurance, or we could say longevity insurance, because these are benefits that are going to be paying to you no matter how long you live. So even that person passing away with less than $10,000 to their name is still receiving a Social Security check so long as they're still living. Could be pretty important these days because people are living a lot longer than they ever expected to. Gentlemen, if you're a married couple, age 65, gentlemen, you have a 50% chance of living to 92. Ladies, you have a 50% chance of living to 97. Now, this statistic often surprises people. And the reason for that is because life expectancy in totality is lower than this. But you have to remember that as you age, your life expectancy actually goes up. And the reason for that is you make it past a lot of those trouble years early on. Also, in today's world, medical technology, pretty good. My granddaddy had 4 heart attacks and 3 bypass surgeries before the age of 75. Okay. He lived to 92. He just passed away last year in December, not COVID, just old age, but he was 92 years old, okay? And he lived much longer than he ever expected. If you'd have asked him at the age of, say, 80, hey, granddaddy, you think you'll live to 92? He would have smiled, shook his head, and said, I don't think so. But the reality is, he still did. Okay, he made it all the way to 92. My granny, his wife, is still living, and she's probably a major part of the reason why he made it so long. So you can imagine what that means, and you're probably right. Can you live as long as this gal? I don't know. This is McCauley Tanaka. She's 118 years of age. She's currently the oldest living person. She is from Japan. Interestingly, of the last 5 oldest living people, 4 of them were from Japan. So either the Japanese lie about their age a lot, or if you're thinking about relocating in retirement, you may want to consider Japan. You know, just saying. All right. Here's what we're going to focus on. We're going to talk about some basics about how your benefits work, how they're calculated. We'll talk about strategies for married couples, options for those of you who are divorced, options for those of you who are widowed, and if you fall asleep somewhere in the middle, please do wake up in time for taxes. I can tell you, having now run personally thousands of analyses, our organization tens of thousands of analyses, that if there is one single item that is going to take two strategies that look pretty good, but they're kind of the same, but then shifts it where one stinks and the other one looks great, it's going to be taxes. So I want to make sure you have a good understanding of that. Let's talk about some basics of how your benefits work, how they are calculated. In order to qualify for a Social Security benefit, you need to have 40 credits. If you are not sure if you have 40 credits, the website you go to is www.ssa.gov. You probably don't have to do the www anymore, but ssa.gov, okay? That's the Social Security's website, ssa.gov. On that website, you can create a login, My Social Security. When you log in, one of the first things you will see on that login page, I know because I did it recently for myself, because I didn't want the government to mail me a statement, which is ridiculous for them to do. A lot of wasted money in my view, but I went on there to say, don't mail me a statement. So Social Security, if you log into the Social Security website, not only can you tell them not to mail you a statement, but you can also see right there the 40 credits. Okay, so there is some green bars that go across, and if they're all green, you'll get a green check right at the end, and that means you have your 40 credits. If you don't have 40 credits, you got to get them in order to get your Social Security benefit. One credit is earned by having $1,470 of earnings in a calendar quarter. So you can earn up to 4 credits per year. Works out to roughly 10 years worth of work, okay? Once you have accumulated your 10 years worth of work, the way your benefit is calculated is by using the highest 35 years of what is known as indexed earnings, meaning it is not the actual dollars that you earned, it's those dollars then increased to account for inflation that are used, the highest 35 of those. If you would like to know how much your income in years gone by is worth in Social Security's benefit calculation, you need to use an indexing table. Inside of our Social Security filing workbook, which we will mail to you if you request it, we will be happy to share with you in that workbook an indexing table, which would allow you to take your benefit statement, your Social Security statement, page 3 of that statement will have an indexing table. In that indexing table, you can pull those numbers, put them on the indexing table, and you will see what your benefit is worth, what those dollars are worth in times gone by. For example, let's say on that indexing table, you saw $20,000 of income in 1980. That was a lot of money back then. How much was it? Little more than $80,000 is what $20,000 was worth in 1980. So you would see, you put that on your indexing table and you multiply it by 4 and change, meaning that $20,000 again worth a little more than $80,000. In order to increase your benefit based upon your work, you must replace a lower income year in the past. Here's an example. Let's say your income today is $60,000. Your lowest income year in the past, indexed for inflation, is $20,000 in 1980. Does the $60,000 today replace the $20,000 in 1980? No, it does not. Okay, so you have to earn more in today's dollars that will replace a lower income year in the past in order to increase your benefit for the future. However, it's not as though your work today is hurting you, it's just not giving you any increases. Now, what happens in the scenario where you don't have all 35 years? Let's say you only have 25 years of work. In the scenario where you only have 25 years of work history, what Social Security will do is they'll take those 25 years, index them for inflation, and then add in 10 zeros in terms of your benefit calculation. So Any additional work that you're doing today is replacing a zero and should have a pretty good size impact in terms of increasing your benefit down the road. There are two major provisions that affect Social Security, and they apply almost exclusively to government workers, either state, local municipalities, or some federal employees. The two provisions are the windfall elimination provision, and the second one is the government pension offset. There's currently a bill in Congress, if this is affecting you, that you want to go lobby for, that would eliminate these two provisions. But basically, here's how they work. If you have a pension that you earned while you were not paying taxes into the Social Security system, you have what is called a non-covered pension. So taking an income from that pension and then simultaneously filing for, say, a Social Security benefit that you have earned will cause you to deal with the windfall elimination provision, meaning however many years of substantial earnings that you have, the calculations are in your workbook, I don't have them memorized, but however many years of substantial earnings you have will affect your bend points and will reduce your benefit based upon the windfall elimination provision. It can't reduce your Social Security to zero. You'll still at least get something, but it can reduce the benefit. Now, the other provision is the government pension offset. The government pension offset is when you do not have your own Social Security, you have a non-covered pension, you receive the pension, and then you apply for a spousal Social Security. If you apply for a spousal Social Security in that scenario, then what happens is 2/3 of your pension reduces what you're eligible from the spousal. And that, if it reduces it to a negative number or zero, you could get nothing. In fact, most people affected by the government pension offset do get nothing from Social Security, although there are some who will get some small amount, okay? Again, all those calculations are in your workbook. I think you know this, but if you don't, you've paid a lot of money into the Social Security system. About 6.2% of your pay you've been paying in over the last 10, 20, 30, however many years you've been working. Your employer has paid the other half of that for a total of 12.4% of your pay. Unless you're self-employed, then you get to pay both. I think if you could imagine an account somewhere with your name on it with 12.4% of your pay over the last, again, 10, 20, 30, 40, however many years you've been working, you could imagine that that would be a very sizable sum of dollars. And if you applied even just a little bit of interest to it, could be a very large sum of dollars. So, is that how it works? Well, unfortunately, it's not. For those of you who already know, it is absolutely not how it works. The way it works is a pay-as-we-go system, meaning if you are working, your FICA taxes that flow into this system, the 6.2 times 2, those dollars are leaving the system right now to pay current recipients. We used to be in a surplus. When we had a surplus, the trust fund was buying treasury bonds, meaning we were loaning money to the U.S. government out of our Social Security system. I don't know why I think that's funny. It just strikes me as funny. So anyway, that's what the system used to do. Right now, we're actively selling treasury bonds, which means we're in the red. Okay, we've been in the red since 2010. We will be fully funded through 2035. In 2036, we're funded 75 cents on the dollar. So that means in 2036, all of you will experience a 25% cut to your Social Security, right? No, wrong. Okay, that is not how it will work. Well, what will happen is they will fix Social Security. If you've not been paying close attention to this, let me inform you that Social Security has been broke many times. This is just the newest iteration, and we got a long time coming. Not that long, it's 2035, 15 years, 14 years now. So it's coming quick, but we do need to fix the system. They'll fix the system, don't worry. Yeah, you know how they fix the system if you think about it. All of you had a full retirement age of 65 when you were babies. Your parents had a full retirement age of 65. But the Social Security system was broke at some point. I can't remember when they made this change, some number of years ago. And they said, nope, none of you have a full retirement age of 65 anymore, right? You all have a full retirement age. The oldest of you, 66. The youngest of you, 67. But probably the majority of you in attendance today have a full retirement age of 66 and some number of months, whether that's 2 months, 4 months, 6 months, 8 months, 10 months, depends on the year that you were born. So what will they do? They will say to your kids and grandkids, yeah, we know we let your parents file earlier, but we're not going to do that anymore. So there's talks about eliminating the age 62 filing. There's talks about pushing full retirement age as high as 70, all different kinds of things. But will that affect you? No. Okay, how can I say that so confidently? Well, unless there's some of you in attendance today who are younger than the age of 55, once you hit the age of 55, current federal law states that they may not change your Social Security benefit. Okay, so it's your children and grandchildren that are going to have to deal with this, and trust me, they will. All right. Let's assume for a minute that all of you have a full retirement age of 66, just for ease of explanation. I know that many of you have various full retirement ages, as I just mentioned, but just for ease of explanation, we're going to operate that everyone has a full retirement age of 66. If you file for benefits at your full retirement age, you receive 100% of your primary insurance amount. Your primary insurance amount is estimated for you on the very front page of your Social Security statement. That big bold number in the upper right corner, that is your estimated primary insurance amount. If that number said $2,000 and you file at your full retirement age, you should get $2,000. If you file early, you are allowed. You can file as early as the age of 62. That $2,000, though, gets reduced by 25%, so $1,500. You can also delay past your full retirement age, turning $2,000 into as much as $2,640, 132%. Those increases are known as delayed retirement credits, and they work out to 0.8% per month or 8% per year. Both the increases for delaying and the decreases for filing early actually happen monthly, not annually, even though we talk about them annually, okay? But they actually happen on a monthly schedule. There are 3 distinct benefits you can file for. The first one is your own work history benefit, the retired workers benefit. That's a benefit you file for based upon your own work history. The spousal benefit is a benefit that you file for based upon your spouse or ex-spouse's work history. A widow or survivor benefit would be a benefit that you apply for based upon a deceased spouse's work history or a deceased ex-spouse's work history. The last time Social Security law was majorly changed was in October of 2015, and basically what they did is they took away all the fun stuff. So if you ever heard about things like file and suspend, get a lump sum check, all that good stuff, all of that is gone, with a couple exceptions. Number 1, if you were born before January 2nd of 1954, and you have not yet filed for a Social Security benefit, and you're entitled to either a spousal or ex-spousal benefit, you can do what is known as a restricted application, start with spousal benefits only, and switch to your own at a later date. But you must have been born before January 2nd, 1954, and you can't already have filed for a benefit. This is a rapidly diminishing group. I'm not going to spend any more time on it than that, but if you have questions, please ask during the Q&A. There are just a couple of things to be mindful of when you're filing your Social Security benefit in terms of filing strategies themselves. Number 1 is that you are allowed to suspend benefits at any time for any reason. Now, why in the heck would you ever want to do that? Well, let's say you were laid off from a job and you're over Social Security age. You say, well, I guess I'm retired. You go ahead and file for benefits. And then a friend of a friend who knows a friend or somebody says, hey, we got a job. We think you'd be good for it. And you say, yeah, I would be good at that. And so you take the job. Now you have employment income and you have this Social Security benefit. You don't really need the Social Security benefit. What should you do? Well, one option would be to suspend benefits. If you suspend those benefits, any delayed retirement credits that you will earn from the point at which you suspend to as late as age 70 will be earned. The only thing you can't earn is whatever time you were collecting Social Security. Those are on. But at the point of suspension till as late as age 70, you can earn increases. Now, what if you wish you had never filed? Let's say it only took a couple and you said, I didn't need this $4,000. What the heck? Well, so long as you pay the dollars back to Social Security, you can tell them to rescind your application one time only, and they will reset your benefit as though you never filed. Okay, but it'd only be one time, has to be within the first 365 days. And you do have to pay back anything they've given you that thus far. Okay, let's talk about spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. In addition, the spouse that you want to file from has to have filed their benefit in order for the spousal benefit to be available. So if my wife and I are the same age, she's a little older, but good example. So if she, let's say she has a $2,000 a month benefit, let's say I have no work history. I don't have a benefit. I want to claim off of her. Well, what's available to me? Well, 50% of hers is what I would be thinking to get. So she has 2,000. I want to get half of that, 1,000. Okay, that's the spousal amount. However, she has to file for me to get half. So if she doesn't want to file, let's say she wants to delay till 70, then I have to delay till 70. Okay, so she has to file for me to get that benefit. Now, what happens in a scenario where I have my own benefit? Let's say my benefit is more than 50% of hers. It's $1,200. Her benefit's $2,000. $1,200 is more than $1,000, 50% of hers. There's nothing available to me for the spousal portion. Okay, I don't get some of mine and some, none of that. Okay, if mine is more than 50% of hers, I'm just focused on my own benefit. Okay, it's 50% of your spouse's primary insurance amount, not the benefit amount. Let's go into that a little more in depth. John's primary insurance amount at his full retirement age is $2,000. Jane, at her full retirement age, is eligible for $1,000. Meaning, Jane is allowed to file early. Let's say there's an age difference. John hits 66, but Jane's still 62. Can she file for a spousal benefit? Yes, she can. But is it a reduced amount, or is it 50% of John's? It's a reduced amount, okay? But if Jane had her own work history and had $1,000 a month, she would get $750 for filing at 62. But if it's not her own benefit, it's a spousal from John, she's only going to get $700. So spousal benefits reduce on a faster rate, on a faster schedule than regular benefits. So if you want to think about it like extra penalties for spouses who file early, maybe that's a fair way to say it. The other thing is that Jane has no incentive to delay past her full retirement age. So you see this 100% here that continues on and on? That's because if Jane had her own benefit of $1,000, she could turn it into $1,320. But if it's a spousal, it never gets higher than $1,000. Even if John delays and is getting $2,640, doesn't matter. Jane's still only eligible for $1,000. So no delayed retirement credits. What's a very common scenario that this is very important to remember? Jane has her own work history. $500 a month is her benefit. John has a $2,000 a month benefit. Jane's thinking spousal. $1,000 is more than my $500. However, John wants to delay till 70. He turns $2,000 into $2,640. Great. Jane likes that. Hey, it's some more money. Great, like that. But what should Jane do? Because she has no incentive to delay. What Jane should do is she should go ahead and file her benefit at full retirement age, and she'll get $500 a month until John files at 70, and then she'll bump from the $500 to the full $1,000. Okay, for my married couples, when one of you passes away, only one benefit remains. It's always the higher of the two. Okay, you don't get to keep both. Only one benefit remains, always the higher of the two. There is a caveat. In the scenario where the higher wage earner files early, say at 62, that wage earner is getting 75% of their benefit. 2,000's been turned into 1,500. Should that person predecease their spouse, the spouse will get a bump up. The 82.5% rule says that the surviving spouse will see an increase from 1,500 to 1,650 because of the 82.5% rule. Two most common mistakes we see married couples make. The first one is that higher wage earner files early and shortchanges a surviving spouse. Remember, when you think about your Social Security benefits, the way to frame those benefits into your plans is as retirement income insurance, or again, we could say longevity insurance, meaning not just for you, but also a surviving spouse. So if you're like most married couples, for those of you who are married, you all want a plan that you die close together, right? Maybe, cutting your 90th birthday cake, you get the sugar rush and that's too much and both of you go at the same time. That's what we want, right? Okay. But we know it doesn't work out like that, unfortunately. It is not uncommon for one spouse to outlive the other. Question is, how long? So what happens if one spouse, say, lives to 75, and then the surviving one of you lives all the way to 95? Could be 20 or more years of one Social Security check. So we want that check to be as high as it can reasonably be. If anyone is going to be doing any kind of delaying, it's going to be that higher wage earner because it's going to take that benefit and really get it up there. The second mistake that we see married couples make is that both will delay past full retirement age. This really just comes from our experience and really factors a lot into tax planning. It almost never works out for both spouses to delay past full retirement age. Again, generally speaking, one spouse will file early to some degree or another, and the other spouse will delay to some degree or another, and it's going to be that higher wage earner that's doing the delaying if anyone's going to delay. Okay? Let's talk about divorced benefits. In order to qualify for a divorced spouse benefit, you need to have been married for 10 years in a row to the same person. Married 5 years, divorced, remarried, even to the same person, 7 years, divorced. 5 plus 7 does not equal 12. Okay, it doesn't even equal 10. Obviously, it doesn't equal 10. But it doesn't equal 12. One of those two stints has to be at least 10 years for the divorce spouse benefit to apply. So I know you did not come on here for marriage counseling, but if you need a reason to hang on, there you go. Okay, you may not be currently married. So if you have a marriage that lasted more than 10 years and you're thinking, gosh, ex-spousal benefits, that sounds pretty good, but you're remarried, say goodbye to the divorce spouse benefits. You're just dealing with either your own or your new spousal benefit. Same benefit amounts in terms of extra penalties for filing early, and no delayed retirement credits when you delay apply to these ex-spousal benefits, as did also those regular spousal benefits. Biggest difference between divorce spouse benefits and regular spousal benefits is our last bullet point here. You are independently entitled to a divorced spouse benefit so long as you have been divorced for at least 2 years. So remember, I just made a big deal about, my wife, if she wants to delay, I have to delay, right? I have to wait till she files. If we've been divorced for at least 2 years, it doesn't matter when she files. I can file on my own schedule regardless of when she chooses to file. If you were born before January 2nd of 1954 and you have a marriage that lasted more than 10 years, and you have not yet filed for a Social Security benefit, the restricted application could be particularly advantageous to you. One goofy thing about divorce spouse benefits: if you manage to fit a 10-year marriage into your lifetime where that person was younger than you, and you hit 62 and file for Social Security on your own record, and then a couple of years go by, they hit 62, and their spousal is more than yours, you can switch. And if you manage to fit another 10-year marriage like that, and they hit 62, you can switch again. And if you managed as many 10-year marriages as you can work into your lifetime, where you can fit that scenario, you can switch, okay, as long as it's more. Common questions we hear from those who are divorced. I'm divorced. My ex is going to file off of me. Is that going to affect me in some way? No, not. I'm divorced. I've remarried. My ex will file off of me. My new spouse will file off of me. Will their benefits affect each other? No, they will not. I'm divorced and I managed to fit a few 10-year marriages into my lifetime, and I've remarried, and I'm going to die young. No, just kidding. All right. So, yes, all these people could file off of your work history. The new spouse could file. It's all okay. It's allowed. Now, if you do, in fact, die young or die early, they can all also get widow benefits. It is allowed. I'm divorced. My ex, I'm going to be filing off of my ex. Will they know that I've done that? No, they will not. Okay, unless you tell them, they have no way to know. It doesn't affect them in any way, and so you can just do it. Okay, don't worry about it. All right, let's talk about widow benefits. Widows are a very special group. They are the only group who can file for benefits as early as the age of 60. To file for benefits at 60, that means you were widowed probably prior to reaching the age of 60, which means that you must remain unmarried prior to reaching 60 in order for those widow benefits to be retained. The very first workshop I ever did, gal in the back raised her hand during the Q&A and said, so if I understand this right, it sounds like I need to delay the wedding. Well, unfortunately for her, it was kind of a big deal. So she was slated to be married in September. This was a June workshop, and her birthday was not until March of the following year. If she remarried in September, she would lose the widow benefit filing option in March of the following year when she turned 60, which means the only benefit available to her at that point would be either her own or her new spousal benefit, but not till 2 years later, because the earliest you can file for those is 62. So she has to wait 2 years, and the amount difference was big. Her new spousal benefit was the larger of the two, and it was just less than $1,500. But that widow benefit was worth just under $2,000 a month. Very nice widow benefit, which means that she was going to give up $500 a month, and she's got to wait 2 years to get that less. So, unfortunately, it was in her interest to delay the wedding. Now, she did go to her priest. I think this is funny. I'm a religious person. You can decide how you feel about it. But she went to her priest and said, so, can we just do the religious part of the ceremony and sign stuff later? And the priest said, no. I said, there's got to be another priest. Somebody will take care of this for you. But she's very devout. The wedding was delayed. All right. Last bullet point. You have to be married a minimum of 9 months prior to the death of your spouse in order for you to get widow benefits. Now, this is not here to hurt people. It is here to prevent deathbed marriages. The only real-life case example I've run into this, so it's not too common, but if it happens to apply to you, it's important. But the only real-life case example I've run into this, gal was married later in life. Husband was in the armed forces, shipped overseas, killed in action. They had been married just less than 6 months. She assumed I didn't hit the 9 months, so I out of luck. However, it wasn't as though he had some terminal illness or known reason why he would be passing. So just had to submit proper documentation, and the widow benefits were reopened. Let's look at another widow case study. John, who we never met, never elected for benefits, died at the age of 64. His benefit at his full retirement age would have been $2,150. Jane, 5 years younger than John, was 59 when he passed. We met her at the age of 60. She attended one of our workshops, and she had remained unmarried. So she's trying to figure out, what should I do? She does have her own work history. $1,197 a month would be available to her at the age of 62. What should Jane do? Well, one option that Jane has, because she is 60, is she can file for widow benefits right now. If she did that, John's widow benefit would have been $1,537 a month. If she collects that from 60 to age 85 when she passes away, then that's a total of $461,000 over her lifetime. Okay, obviously we're not doing any inflation here. Okay, but $461,000. So not too bad, but Jane has other options. Now the real Jane is still working and she doesn't want to make any big changes. So the real Jane intends to work for a couple more years. So what should she do? Well, okay, the real Jane is going to actually work 2 more years and then retire, at which point she'll actually start with her own benefit, $1,197, and then switch to the widow benefit, which widow benefits maximize at your full retirement age, okay? You don't go to 70 with widow benefits. They max out at your full retirement age. So she switches to John's there, $2,150. Over her lifetime, that's an extra $77,000 simply for understanding and knowing her options. But there's another way she could go. Let's say Jane was ready to retire. What should she do then? Well, she should go ahead and file for those widow benefits, $1,537, and her own benefit increased to full retirement age, then maximized to age 70, is worth $2,108 by the time she hits 70. Over her lifetime, total benefits, again, non-inflation adjusted, $563,000. Over $100,000 more simply for understanding her options. Now, I'm always struck by these numbers, 400, 500,000, because, I mean, let's be honest, it's a lot of money, okay? And this is a single person. Not uncommon for me to see numbers from married couples over $1 million, even single folks over $1 million once you factor in inflation. As high as $2 million I've seen for married couples. So, look, these benefits for many of us, and maybe I'm preaching to the choir because you're here, these benefits, these decisions could be some of the single biggest financial decisions that we make. So, look, I know that you're here. I'm glad that you're here, but continue to take this decision seriously. Maybe I'm preaching to the choir, but really dig in, take it seriously. These benefits are a big deal. Okay. I mentioned a minute ago that the real Jane was going to keep working, so she wasn't going to file Social Security. Why? Well, in her case, she was going to have to deal with this thing called the earnings test. The earnings test applies whenever you file for Social Security prior to reaching your full retirement age. If you are your full retirement age or older, you may file for Social Security, have earned income, and it's no problem. Earned income being W-2, 1099, or self-employment. You're allowed to have both so long as you've reached your full retirement age. However, if you have not yet reached your full retirement age, you have to deal with the earnings test. Here's how it works. The earnings test says is the first $18,960 of your income, Social Security, they don't care about that. But the minute you go above $18,960 in earned income, Social Security starts caring. They care about $1 for every $2 that you earn above the limit. Let's take an example. Let's say you have a salary of $58,960. Sort of an odd number, but the math is easy, and you'll see that. So the $58,960, Social Security does not care about the first $18,960, so we take that off the top, meaning you have $40,000 above the limit. It's a 1 for 2, so we chop it in half. You have $20,000 of Social Security that you are ineligible for if you file prior to reaching your full retirement age and you have earned income at $58,960. So if my benefit that I'm filing for is a $2,000 a month benefit, here's how that works. $2,000 goes into $20,000 10 times, meaning I do not receive a benefit in January, February, March, April, May, June, July, August, September, October. Then I get a $2,000 check in November and a $2,000 check in December. Some people mistakenly assume that when they go above the earnings limit, they will reduce your check, but you'll still get a check all year. They simply will not pay you anything until you've paid back what you were ineligible to receive. In the scenario where you have not yet reached your full retirement age, but your full retirement age is this year, the earnings test goes up to $50,520. And it's a 1 for 3. It almost never applies to anyone, so we won't spend any more time on it than that. Let's talk about taxes. So you can have earned income and collect Social Security, but you got to worry about taxes. You can have Social Security and pension income, withdrawals from your 401k accounts, ordinary income, interest income, dividend income, all kinds of income, and Social Security at the same time. And there are taxes that you have to deal with. No surprise there. But the taxes that you have to deal with on Social Security, unfortunately, are a little complicated. What's on your screen here is Publication 915. Publication 915 says, in 33 pages, exactly how you will calculate how you pay taxes on your Social Security benefits. Why does it take 33 pages? Call your congresspeople. Okay, there are worksheets in this document that are helpful. A little painful to say that, a little tongue-in-cheek maybe, but not too bad, but this is one of them. Okay, this worksheet details out for you. It's very helpful to me, actually, but it was painful the first time I went through it. It details out for you the 19-step process that you must go through to calculate how much of your Social Security benefits will be taxable. Yes, TurboTax autofills this for you. Okay, so don't freak out. But the point is that it's not a straightforward equation. How much of my Social Security is taxed? 19 steps later, I could tell you. Okay, so what we're not going to do is we're not going to go through all 19 steps today. Okay, we're not going to do that. All right, maybe we'll do that, but not today. Okay. What we're going to do is we're going to highlight some things to you from our experience that we find is very helpful to people when they're thinking about how these benefits are taxed and what they should be mindful of. Line 1 of that worksheet is where you put your provisional income. Provisional income is the number that is used by the IRS to determine how much of your Social Security will be taxable. If your provisional income number is, single folks, more than $25,000, you start paying taxes on Social Security. Married couples, provisional income above $32,000, you start paying taxes on Social Security. Single folks, if you hit $34,000 of provisional income, up to 85% of your benefits could be taxed. Married couples, $44,000 of provisional income, up to 85% of your benefits could be taxed. 2 questions you should be asking. 1, what the heck's provisional income? 2, how much tax? Let's deal with both of them. Provisional income is all of your adjusted gross income, earned income, pension income, dividend income, interest income, ordinary income, withdrawals from 401ks, IRAs, 403bs, RMDs, okay, all the income that you have, K1s, rental income, doesn't matter. If it shows up, that's part of your adjusted gross income, okay, capital gains, long and short, all that, okay? So that's number 1. No surprise there. Number 2, municipal bond interest income. For those of you who buy municipal bonds, you buy it because of the tax savings. Unfortunately, Social Security did find a way to get at that, and the way is by including it in your provisional income number. Okay, I should say the IRS figured out a way to get at it. 3rd item. Okay, so we got all your income, non-taxable interest.
and 50% of the Social Security benefits that you're eligible to receive count towards the number that determines how much tax you owe. Okay. All right. So that one's a little bit of a stinger, but it is how it works. Most people are above these limits and pay some amount of tax on their Social Security. So the question is, how much tax? You see, Social Security is technically tax advantageous because the most you could be taxed on is 85% of the benefits. Technically, it's tax advantageous. The problem happens when you don't properly account for the tax ramifications of your other sources of retirement income while you're receiving Social Security. Let me give you an example. Let's say you're cruising along through retirement. You've got Social Security. You have some pension dollars or withdrawals from 401ks, IRAs, 403bs, something like that. Okay, so you got your retirement income and everything's going fine, right? You're doing well. You're enjoying life. You're enjoying your retirement. Everything's good. But, you've been cooped up a little bit. You're feeling like some travel might be nice. It's time to get on an airplane. Maybe you've gotten your vaccines or you're just, going to drive around or whatever you want to do. It doesn't matter to me. You're going to go do some traveling, though, because you would like to enjoy your retirement. And it's time to get out there. Check off some bucket list items. So you're going to go on a nice trip. How nice? Let's say $10,000 nice. Okay, so not out of the world, but you're not flying on one of these rocket ships going up into outer space with Mr. Bezos on 10,000. But you're going to go enjoy your retirement. So you budget things out. You spend $10,000 on a vacation. Well, you're going to pay for that. So you look at your accounts. Where am I going to pull this $10,000 from? I like to go on this trip. I need to pay for it. Where am I going to get my $10,000 from? So you survey your accounts, and my 401k is done well. It's grown nicely. Market's doing good. What did I save all this money for? I saved it for me. Okay, I'll pull it from there. So you call up your 401k plan, say, I'd like to pull $10,000, please. And they say, no problem. Then they ask you a very important question. How much tax would you like to have withheld? Oh, yeah, right, taxes, no problem. Good, I can do that. But you're not quite sure, so maybe you check your tax return or whatever. Okay, you think it through. And you figure out, okay, I'm in the 12% tax bracket, so I'll withhold 12%, please. No problem. They send you your dollars, withhold the taxes for you. You go on your trip, everything's great. You get into next year, and then March rolls around, and you are punching things into TurboTax. And TurboTax is broken. It says, I owe money. I never owe money. I always withhold enough. Unfortunately, TurboTax isn't broken. Here's what happened. When you took that $10,000 distribution from the 401k, you didn't account for the fact that you were above these limits. You were correct. It was taxed at 12%. But what you didn't account for was that you caused additional Social Security dollars to become taxable. You didn't get more money from Social Security. You just added taxes to Social Security. So the effective tax rate on that distribution, 12% here plus 12% here, is 24%. Now, that's no fun. No one likes paying in at tax time. But that's not the bad one. Unfortunately, we see all the time that people are headed, beelined, right for a very large tax problem. And that very large tax problem sounds something like this. You've done a lot of good things in your life in terms of preparing for your retirement. You put some money into your 401k accounts. You've maybe maximized them or at least gotten your employer matches. Your employer's put in some more dollars. You built up this nice 401k retirement account or 403b or 457 or TIA or TSP or whatever kind of account that you built up. But this kind of account has a glitch. The glitch is that although the account grew quite nicely and you got to retirement and everything's good, and you didn't want to spend too much because, gosh, you want to make sure that you can take care of yourself. You don't know how long you might live. I need to make sure I have enough money. I might live a long time. I want to care for myself. I don't want to be a burden to my family. And so you don't pull too much from that account. So what happens? It continues to grow. You're in retirement and that account keeps going up, up, up. And then one day you turn a wonderful, magical age of 72. And all of these types of accounts, your TIAAs, your TSPs, your 403Bs, your 457s, your 401Ks, IRAs, simple IRAs, SEP accounts, okay, all of these types of accounts have at the age of 72 is the current law, what is known as a required minimum distribution. The required minimum distribution says mandatorily you must pull money from those accounts. And the larger the account, the larger the distribution will be. Now, if that account gets very large, it could be so large that not only are you above these limits, adding taxes here, but whoops, the distribution was so large that you bumped up the tax brackets. Now it's not 12 and 12 is 24, it's maybe 22 and 22 is 44. These are the kinds of tax mistakes that you need to be mindful of, and you really should do some pre-planning around. Unfortunately, we see many folks who are headed for this problem, shall we say, maybe unwittingly, okay? Do the pre-planning to make sure that something like this does not happen to you. Let's look at a case study that kind of highlights why tax issues on Social Security are so important. Clients are 64 and 62. They have just over $34,000 in Social Security benefits if they file early. They have $752,000 in 401k and IRA assets. They will earn 6% on those investment accounts, and they'll need to increase their spending of $70,000 per year by 3% per year to keep up with inflation. They'll live to 86 and 89 respectively. Now, there are three groups of you who are hearing this scenario. Group number one is saying, yeah, okay, maybe tweak this. It's pretty close, but, it's pretty close. Okay, pretty close to me. Maybe adjust a couple things, but it's not too far off. So look, obviously, this scenario is going to be very meaningful to you, and so hang with me. We'll get right into it. The second group of you is looking at this, and you're saying, 752,000? What happened? Didn't they have any kids? Okay, so look, if you feel that way, if you're saying, gosh, that seems like a lot of savings, wow, I wish I had that, then I need you to pay attention because this couple with $752,000 has a running out of money problem. And we're going to show how Social Security, specifically a change in the Social Security filing strategy, can fix that problem. So stick with me. There's another group of you who's looking at the 752 and saying, yeah, I knew you were going to say that. They didn't work long enough. They got to keep working. They didn't save enough. They got to put more dollars away. That's not enough. I knew you were going to say they're going to run out of money, Kyle. So look, if that's you, if you're looking at this scenario saying, I don't know about this, then I need you to pay attention because this couple with only $752,000 has a tax problem. And we're going to show, again, how a change in their Social Security strategy can solve that issue for them. Okay, so let's go into it. This couple, if they do in fact file Social Security early, those blue lines there, you see it's covering about 50% of their retirement income need early on. Doesn't quite hit 50% as inflation hits because Social Security, unfortunately, does not keep up with inflation. They use the CPI-W index, whereas you spend money at the CPI-U index. Lags behind historically by about 1%, and I know you're all very amazed to hear that. Okay, the red line is the amount they need to hit their income need over time increasing with inflation. The yellow lines are the withdrawals from the 401ks. The amount of the yellow line, I know for you it's probably orangish, orangey yellow. The amount of the orangey yellow lines above the red line is the amount that they're paying in taxes. you are noticing correctly that those taxes really seem to go up fast. Yes, that's because of that double taxation process I just described a moment ago. As they have to pull out more and more from their investments, they cause more and more of Social Security to become taxable. And eventually, all of this pressure on their portfolio causes them to run out of money 14 years too soon. Now, this couple and many other folks have lots of options on ways to manage tax exposure, better manage their retirement income streams, structure of investments, all that kind of stuff. But we're not doing any of that. Okay?
The only difference between this slide and the next slide is a change in the Social Security strategy.
Not doing any Roth conversions, no advanced tax planning, none of that stuff. Just a change in the Social Security filing strategy. Let's see how it looks. If this couple in the early years will get all of their income from their 401k assets, they do pay a little bit more in taxes in those early years. Remember, technically, Social Security is tax advantageous. There again, unless you improperly manage your other sources of income. So, they get all their income in those early years from the 401k accounts. They optimize Social Security filing at a later date and look at how much more of their income is covered by Social Security at that point. Meaning, they don't need to pull out hardly anything from their 401k accounts by comparison. Meaning, they get to enjoy some of the tax savings on Social Security. Now, there's a little bit of orange line above the red, but not much. It's not uncommon when we do pre-planning for folks to get them into a position where they pay very little and sometimes even no taxes. Also, you'll notice their portfolio lasts their lifetime. They take all that pressure off and their portfolio lasts the rest of their life. If we compare year by year, you'll see that yes, optimized, blue lines, they pay a little bit more in taxes in those early years. But non-optimized, look at all the excess taxes that are being paid simply for filing Social Security early. Now, eventually they stop paying taxes, but they're broke, so it's not a good deal. Okay. This couple, when they optimize Social Security, is able to get $186,000 more out of their Social Security benefits. Also, their portfolio lasts 14 more years. Also, they pay $35,000 less in taxes, even though they weren't paying any taxes for 14 years when they went broke. They still save $35,000 in taxes by using that optimized Social Security strategy. A few things about your Social Security statement. Number one, no cost of living adjustments are applied to that statement. It's just a snapshot of today's benefits. The statement itself assumes that you work all the way to 62, retire, file immediately, or all the way to full retirement age, retire, file immediately, or all the way until 70, retire, file immediately. Okay, it doesn't account for example, you retire at 65 and say don't collect benefits till 70. Your statement's not really accounting for that kind of detail. It's your work history only, no spousal coordination, no widow coordination, ex-spousal benefits, none of that stuff. And obviously, no advice. So look, after hearing our presentation today, you may or may not feel that you could use a more individualized, specific look at your specific Social Security filing strategy needs. If you are thinking to yourself right now, if you're imagining, gosh, I can't even imagine trying to make this Social Security decision without considering taxes and what it does to my investments and how that's going to play out and how that will affect me over the short term and long term, both from taxes and will my portfolio last. If you're having those kinds of thoughts, we are exactly of like mind. So this analysis can really help with that. Okay, to help you really evaluate things. The analysis that we will provide to you, should you choose to take advantage of it, is available to you at no cost. It's free. Why? Why do we provide something that is so valuable for free? Okay, it's not rocket science. Okay, it's very straightforward. Let's use an analogy. Once upon a time, I don't know, I haven't been back recently in the last few weeks, so I'm wondering if this will be true now. But you remember going to Costco on the weekends? Anyone ever been to Costco on the weekends? Horrible experience. Hey, there's nothing good about it, except that on the weekends at Costco, they give you samples, right? Okay, we love the samples. My favorite sample at Costco was the grass-fed beef bratwurst. Thing was pretty good. I started buying them because of the samples. So that's the idea, right? That they don't give you the samples just because they want to make sure that you're not hungry while you're shopping. In fact, maybe the opposite. They give you the samples so you try something and you say, hey, that was pretty good, and maybe you make a purchase. We sort of feel the same way about our analysis. We believe that this analysis is a very good sample of the work and the value that we are able to provide to our clients, but also we extend that offer to you to see the type of value that we provide. It is our hope that when you get this analysis and you see the valuable work that we provide to our clients, that will then give us the right, or maybe I should say the privilege, maybe I should really be saying the honor, of serving you with other retirement planning or investing needs that you may have, okay? The analysis is at no cost. So, hard to lose on that one, but what's in it, right? Because you could just waste a lot of time. But I hope I've done a good enough job today to think that maybe we could do a good job on analysis for you. Let me share with you what's in it if you're thinking, gosh, an analysis, that might be really helpful to me. Here's what's inside. Number one, step-by-step details on how various methods of filing for Social Security will generate different benefits. This is a snapshot of one, but we can generate lots of different options for how you could file. We'll highlight the ones that we think make the most sense based on your specific needs and circumstances, not just looking at Social Security, accounting for pension benefits you may have, other income sources that you may have in retirement, thinking about taxes. We will account for those in this analysis and really highlight for you the step-by-step process of exactly when it would be best for you to file. And then if some of them look kind of close, like, hey, maybe a few different ways to file could work out, we'll do a break-even analysis. Which one makes sense in what scenario and why? Which one best protects a surviving spouse who lives a long time? Which one provides the most benefits to someone if they were to happen to die soon? You know, we look at all of those different variables. We also will look at the time value of money, make sure we're not missing out because we just see a big number down the road, but we don't account for things in the short term. Okay, all of this is a part of the analysis, very important. Probably the single most valuable part of this analysis, the thing that really sets it apart, the thing that will cause you to say, wow, I'm just so glad that I got this. Okay, the thing that will cause you to say that really comes from this part of the analysis. This is our retirement income, cash flow, and tax analysis provided specifically from our Retirement Defender software tool. This is a software tool that, well, frankly, paid a lot of money, and I spent a lot of time personally helping to develop. This software tool allows our team to do very specific, line by line, detailed analysis of your retirement income streams and cash flow, as well as those Social Security benefits, highlighting exactly how they will affect you from a tax perspective, and also identify different tax planning opportunities. For example, this couple is going to benefit from a $42,350 Roth conversion. Now you'll notice that's not a $40,000 Roth conversion or a $45,000 Roth conversion, some more broad-based number. It's a very specific number, $42,350. Okay, that's the level of detailed pinpoint analysis that we do when it comes to tax planning. You just don't mess around with the IRS, if I could say it like that. So This will also be made available to you as a part of that Social Security analysis, and we're happy to do that. Okay, we'll also evaluate, does it save you in the long run? This couple is able to prevent their full 85% from being taxable, and they get to enjoy some tax savings on Social Security. We also can evaluate, did it make a difference? Did it improve your net worth? Did it help you get more tax-free dollars? This couple was able to get an extra $700,000 of tax-free money. So that's a good deal. Okay, what will your numbers look like? We'll just have to see. Okay, but your analysis will include this portion. Okay. If you think that analysis could be helpful to you and you'd like to request it, you will go to the same website to request the analysis as you go to request the workbook. To request our Social Security filing workbook, you will go to sendworkbook.com. At sendworkbook.com, you will fill out your information and we will be mailing you a physical copy of the workbook. Okay, so please do that at any time. We're happy for you to do that. Okay, and when you're in sendworkbook.com, you may also request that Social Security analysis. Let me say a few things about that analysis process for those of you who are thinking that that is something you would like. Okay, number one, Einstein Retirement Workshops is an educational brand that at one time was separate from my firm, City Center Financial. Today, City Center Financial owns and operates the Einstein Retirement Workshops brand. It is something that we acquired a little more than a year and a half ago now. Okay, so we own and operate Einstein Retirement Workshops. Okay, that's an important point, and I want to highlight that for you in addition to some other things. And the reason why is we have to be very transparent. We are a fiduciary firm. Every single one of our advisors is fully licensed, certified, credentialed. They're also national Social Security advisors, but we're all fiduciaries first and foremost. And so as a fiduciary firm, we have to be very transparent with you. So let me be transparent about a few other things. Number one, doesn't matter what state you are in, we are able to provide this analysis to you. Okay, we have clients in all states across this great nation. We have clients in Hawaii. We have, I think we just got a new client in Alaska. We have clients in Maine, all the four corners, Florida also, Washington, yes. Okay, we have clients everywhere. And so it doesn't matter where you are. We can provide this analysis to you. Okay, number two, eventually the free stuff runs out, right? We're going to send you the free workbook. We're going to give you a free analysis so you can sample the value that we're able to bring to the table for our clients. Eventually, though, we can't work for free forever. So when that day comes, there are two ways that our clients hire us. Method number one, and the most common method, is that many of our clients do elect to have us manage their investment accounts. If you hire us through the managing of your investment accounts, you will pay investment advisory fees. The investment advisory fees that you pay are largely dependent upon the level of complexity that we bring to the table for your investment situation. The majority of our clients pay less than half of the national average, which is 1.5%. Okay, we have clients that pay as little as 0.5%, depending on the complexity again of the strategies we're implementing. We have clients who pay as much as 1.25. Yeah, I said that right. 1.25%. And those are clients who are using algorithmically driven strategies, very complex stuff. Okay, so your fees can vary based upon the level of investing sophistication we're implementing for you. Okay, but we'll disclose all those up front, and we don't shove it down your throat. You get to decide how we do it. Okay, all right. Second thing, way that our clients hire us, we can work on an hourly fee. Our hourly fee is based upon the experience and expertise of the advisor that you're working with. So they can share that with you. Whoever you get paired up with, any of our highly qualified advisors, they can discuss with you and disclose to you exactly what their hourly rate would be should you choose to work with them in that capacity. Okay. Okay. We will interact with you for these meetings via video conference. Our team is fully equipped to work with you in a secured and encrypted fashion over video conference. We will be on video, absolutely. We'd love if you're on video, but it's totally up to you. It's your call, okay? If you prefer not to be seen or you don't want to comb your hair, no problem, okay? But we'd certainly invite you. We'd love to see you face-to-face on that Zoom call. We've gotten great feedback from our clients about that experience. They've really enjoyed the ability to work with an advisor, really from the comfort of their home, but also we have many clients who relocate, have vacation homes. They actually really enjoy that flexibility of being able to meet with their advisor really at any time at a moment's notice. And so we have enjoyed that process, and our clients have given us great feedback about it. Okay, I'm going to take questions here in just a second, so punch your questions into the chat portion, either on YouTube or Facebook. I can answer them either way there, so punch those in. At any time while I'm answering questions, you can open a new browser tab, or if you're watching this on your phone, you can open it on your computer, whatever you want to do. You can go to sendworkbook.com. Do that. Make sure that we can mail you that workbook. We're happy to do that. So please request the workbook. If also you're one that's going to engage with us for that free Social Security analysis, we're very honored for that, and we're happy that you take advantage of it. Also, as a part of that, when you're clicking through and you're requesting the analysis, you may also be offered to take advantage of our Retirement Defender Screening Report. If you're really taking retirement seriously and you want to make sure that you're set up well for that, you want to make sure that you're ready to go, that Retirement Defender Screening Report is something that we will provide to you also at no charge. It does take us a little extra work, but it's something we're happy to do for those of you who are really taking your retirement seriously and want to see, hey, am I ready to go? That report is the entry point into our retirement planning process, and it allows us to evaluate the 7 critical areas that we think need to be kind of ready to go for you to be, quote unquote, retirement ready. So we'll evaluate those for you, and we're happy to do that. Just simply, when it offers it to you, just say, yeah, I'd like to get that report as well. Okay, let's start taking questions. Okay. Wow, a lot of great comments here. I'm still looking for a question, but I really appreciate the comments. Thank you. Okay, Valerie says, what do I need to do to have you send me my book? I already attended the class. Please let me know or send me the link. I don't want to have to attend another class. That's no problem, Valerie. Just go to sendworkbook.com, and we'll be happy to get it going for you. Okay. Catherine says, how do I find out my ex-husband's Social Security amount and whether he has filed? Well, if he's your ex-husband, you've been married divorced more than 2 years, it doesn't matter whether he's filed or not. You can file regardless of him. And then how much you can take your marriage certificate and divorce decree and make an appointment with Social Security, and they will give you that information. Thank you. Appreciate that. Okay, Tammy's asking, did you say an ex-spouse has to file in order for the ex to file based on theirs? No. Okay, so that's the difference between ex-spousal benefits and spousal. So ex-spousal benefits, so long as you've been divorced for more than 2 years, you can file on that work history regardless of whether they filed or not. Darlene? Oh, I assume you mean you've requested the stuff. Okay, great. Good, Darlene. Laura, it'll stay available for about 12 hours, so yes. Okay, Barbara says, I'm married, age 62, and my husband is 66 and is still working. Should I take mine at age 63? Well, Barbara, there's a little bit too many variables for me to say for sure. There's a good chance. I mean, maybe. Okay, it's just a big maybe. if his income is enough, you might wait till he retires to file for yours, and then maybe delay his to 70, say to maximize the survivor benefit, something like that. I do hope you're getting the analysis, because the analysis will really help you answer that question very well. But there's a lot of extra questions I'd have to ask to really tell you. Okay. Oh, great, Nancy. Good. Leona May, great. You're welcome. Okay, Mary French is asking, so generally speaking, is it best to use money from a 401k before taking Social Security early? So I have a trouble saying, speaking too generally. What I would say is that very often that does turn out to be a great strategy, but it's not a guarantee, okay? Everybody's individual situation is going to modify that, okay? This couple, because they're married, that also has a modifying factor. Okay, it actually is a little harder for single people because of the tax brackets and how they're structured and the standard deduction. It is often a little harder for single folks to use a strategy like that to its full effectiveness in the same way that a married couple can. So hard to say generally, but it's often a very good strategy. I think you understood the concept very well. Whether or not it's the right idea for you, you just have to really dig in and compare. Okay, you got to compare both methods to see if it's the right way to go. Okay, Frankie Reed says, are my years as a soldier affected? I assume you mean, does that affect Social Security? And the answer is probably not. Probably not. Okay, Diane says, I'm 66, working full-time and trying to hold out to 70 for collecting Social Security. Did I understand you say that if I can't make it and have to quit at 68, I should pull from the 401k rather than pulling Social Security early? Yeah, possibly, right? That might, as I just mentioned, there's a very good chance that might be the best strategy for you. But again, it's not guaranteed. Okay. Again, single folks especially. I don't know if you're single here. You didn't mention a spouse, so I'm operating under the assumption that maybe you're single. Single folks tend to get less benefits from delayed strategies as compared to married couples. But again, it's not a blanket rule. Everyone's individual situation can vary that. Okay, Nancy says, I plan to retire from a full-time job at 65. I also have a part-time job. Should I delay Social Security till full retirement age? Probably, Nancy, at least, if not longer. Okay, Catherine says, do I need info on my ex-husband prior to an analysis by your firm? The answer is probably not. I think I just kicked let's see here. Yeah, hold on. My microphone situation got a little screwed up. Let me try and fix it. Okay. I think it probably just got really loud. Sorry if that hurt anyone's ears. I'll give you a moment just to adjust. I don't think it's going to correct at this point. Sorry for that. The fun of kicking a thing here. Okay, so let me go back. I'm sorry. Questions reloaded. Okay, let's see. Oh, shoot. Okay. Okay. Well, my questions got a little screwed up here, so let me just do the best I can here. So Steve is saying, what about Roth income? So Roth income does not count against you for your Social Security taxes on Social Security. Okay. Bree is saying, can you still work at 62 and receive the ex-spouse's Social Security, or maybe only part-time? Yeah, but you have to earn less than $18,960. Otherwise, you have to deal with the earnings test. Okay, I'm sorry that this little tech issue happened. I lost some. I didn't lose your question. I just put them all out of order for some reason. Okay, so I'm going to just keep going. But again, at any time, sendworkbook.com. Also, request the analysis. Happy to get that going for you. Let me keep trying to do questions here. Would it be a mistake to not file an ex-spousal benefit? I am approaching full retirement age in a year. There's a good chance you can't file the ex-spousal benefit. If your work history entitles you to a benefit that's more than 50% of your ex's, you're only entitled to your own. The ex-spousal is not relevant to you. Okay, Gary Daniels says, I retired 3 months ago. I'll retire comfortably with a company annuity and Social Security. I'm 70 as of April. In addition, I also have 70% in a 401k and 30% in a Roth in mutual funds. I don't need the money now. Should I roll the 401k into the Roth now and take the present tax hit, or let the 401k ride? Gary, the analysis will answer that for you very easily. I hope you're taking advantage of it, but there's a good chance that maybe not taking the hit all at once. We have through 2025 on the current tax code. So you really have 5 years, 21, 2, 3, 4, 5 years to do some tax planning. So maybe you want to spread that out over the next 5 years rather than just doing it all at once and taking a hit. Okay, let's see. Okay, Miranda says, my ex passed away. He never drew Social Security. Can I draw on his? Yes, so long as you're at least 60 and you did not remarry prior to the age of 60. The answer is yes. Okay, Linda's informing us that TurboTax is not the only game in town. All right, maybe in my next workshop I'll pick H&R Block online. Okay, all right, good. Thanks, Linda. Saw the booklet flash on the screen. Very interested in reading it. Okay, great. Can I select and begin my benefit while living abroad, Dan asks. Yes, the answer is yes. Susan, you can watch this for another 12 hours, so just try to give it a go. Okay, Laura Davis is saying, can I file for a spousal when my husband files at 62? I am 63 and self-employed. Most likely, except you need to be mindful of the earnings test. So your maximum earnings is $18,960 before you have to deal with the earnings test. Okay, Iggy Samsoil says, about taxes. Is it true that if one's total AGI is more than $32,000 and $44,000, that one is taxed at 50% and 85% on adjusted gross income, or is that only the Social Security part is taxed at that rate? Neither. Okay, neither is taxed at 50 or 85%. The tax rate is based on your tax bracket, but it's a little more complicated than that. It's that double taxation. It's called the Social Security tax torpedo. Everyone has a magical Social Security tax torpedo corridor that you need to be mindful of. And so if you get the analysis, you'll figure out where yours is. Okay, Steve is saying, does the time that I file, now at age 64, until 6 years from now at 70, affect the availability of Social Security? In other words, do I have to apply now to ensure that I get something? No. So current federal law says that at age 55, your benefits are already guaranteed to you. Judith is very interested in taxes. Great, great. Okay, looking for the indexing table, right in your workbook. Go to sendworkbook.com. Hope the analysis will be of help to you, so please request that as well. Okay, Judith is asking, what are factors to look at for filing Social Security at 67 versus 70, using 401k funds and waiting until 70? Well, the things you want to be mindful of are obviously the both short-term and long-term tax situation. Also, is your income such that Roth conversions could help optimize your income so that when you get to age 70 and file for Social Security, maybe you could drop your taxes down to very little or maybe even nothing. Okay, so those are the kinds of things you want to look at. Okay, Janie Blair says, does it make more sense to work until I'm 70 to collect Social Security and get the 8% increases? Or should I start collecting now at 68 and leave that money on the table and then continue to wait for another year? Yeah, so probably it's going to work out best for you to delay till 70. Probably. You know, the analysis, if you're getting it, will tell you that for sure. But most people are a little better off getting the guaranteed 8% increase. Robert agrees. Tina is 59 and trying to learn ahead. Good for you, Tina. That's great. That's really great. Glad you're doing that. Okay, people want the workbook. If you want the workbook mailed to you, you got to go to sendworkbook.com and we'll mail it to you. You'll give us your address. We'll do that. Okay, so you can click on the link that's in the comment section, or you can just jot it down, pull it up later, or put it in now. Sendworkbook.com. Just type that into your browser. Sendworkbook.com. It'll get you going. Okay. Let's go. Steve is saying IRAs are a scam. Well, I'm not sure I would use that word, but I get it. And he's a Roth lover. Good for you, Steve. I'm in agreement. Okay, Robert. Of course, it just jumped around here. Okay, Robert's saying, can my age 68, soon to be new foreign wife at 60, you're 68, at 65, as soon as we marry? No, you have to wait 1 year. Okay, so it's a year wait. Well, okay. Once we get enough comments, I can't keep track of them anymore. So I'm going to try and answer a few more questions. Sorry if I missed your question. But I'm trying to get as many in here as I can. The tax consequences. Good, Rosalinda. I'm glad that was helpful to you. Okay, here's one. Okay, I have a small Roth TSP and a separate small annuity and a small 401k. How do I determine what my retirement amount will be? I'll be 62 in September. I am a widow. My husband passed away, 61, 11 months. I do not plan on retiring until I'm 68. Made much more than my husband, so my Social Security will be higher. Anything I can claim on my SSI. So there's a good chance, based on what you just described, that you will want to file widow benefits at your full retirement age, Teresa, regardless of whether you're still working or not. Most likely, and if you're getting the analysis, it will say this, you want to start with those widow benefits at full retirement age and then maybe switch to your own maxed out benefit at 70. Did not see a link for the retirement analysis. Okay, Linda, so when you go to sendworkbook.com, you got to fill everything out. And it'll say, do you want to take advantage of your analysis? You just say yes. If you say yes, it'll take you to the next thing, which I think is like, can't remember exactly, but it's like, do you want to get your assets coordinated with taxes or other things? If you say yes to one of those, then it'll take you to the retirement defender. Okay, if you say no to both, then you don't have a complex enough situation to get any benefit from that defender report. So you got to say yes to at least one. I either need to do some tax planning, or I need to coordinate my Social Security with other forms of retirement income. If you say yes to one of those, then we know you have a complex enough situation to warrant that retirement defender screening report. Okay. Ed's saying, how can your analysis help if I've already started benefits and I have a wife who works that hasn't? Well, it's the biggest part is going to be around tax planning, Ed. Okay, that's going to be the biggest part. Although certainly, helping you think through the timing of your wife filing is going to be helpful also. Okay, let's see. I just saw someone said you missed this one. Does provisional income also include Social Security, Darlene asked. Yes, 50% of the Social Security benefits count towards that provisional income number. Okay, let's see. Okay. Well, I know that I missed some of your questions. I'm very sorry for that. But I hope I answered the majority of them. And I'd love to see everybody at a future event. If you haven't already, subscribe to our YouTube channel. Follow our Facebook page. You'll be alerted when we do these. And we'd love to see you at a future event. Happy to answer your questions next time. Sorry for the little bit of tech issues we had here towards the end. But I'm confident that that I think I got to most of you. So I do apologize if I missed your specific question. Again, sendworkbook.com. Request the workbook. Request the analysis. Happy to do that. Honored to provide that to you if that's something that'd be helpful. If we see you at a future event, we'd love to do that. If we see you in this analysis process, we'd love that as well. With that, we'll wrap up for tonight. I wish everyone a very wonderful and restful night and sleep. Unless you're on the West Coast, then you got a few hours. But I do hope you enjoy your evening. With that, we will say goodnight for now.